The first BRICS expansion in over a decade is happening as the Gulf oil powers join the bloc. This is what I have been talking about, dreading, and trying to prepare you for. Welcome, everybody. Welcome to this edition of Crashes and Taxes. I am your host for this podcast, Rebecca Walser. And in case this is your first time, maybe a friend has sent you the podcast because they want you to understand what they believe is going on as what I believe is going on. And so they sent it to you. So let me give you a little bit of my background, just so that all of our new growth of podcast viewers can know who I am. So my undergrad is in finance. I graduated at the top of my class at University of South Florida. Worked for Price Waterhouse at the time, right out of college. My boss was the global managing partner for management consulting services. And on financial management consulting services. And I did that for 5 years. I went to AT&T, which was being bought or acquiring the networking piece from IBM. And went through that merger, did that for a couple of years, did real estate finance for a while before I went to law school. So my whole career, over 10 years of professional experience before becoming a lawyer. I went to the University of Florida, graduated magna cum laude from the University of Florida with my law degree. Then I went to NYU and got my advanced tax law degree. So I am a lawyer and I have an advanced tax law specialty as a lawyer. And then I have my final degree from the global what we call TRIUMPH program, which is a consortium program of the London School of Economics, New York University, and what we call Enchanté, which is a school based in Paris, the #1 global business school based in Paris. And that is my final degree. I started my practice independently 9 years ago. I'm in my 9th year of my practice. And we are a wealth management advisory. So we are looking at tax implications, macroeconomic, global, geopolitical implications of your portfolios and what you're doing. That's my practice. This podcast, Crashes and Taxes, is a forum for me to come on here and give you my opinions on what is happening. I don't give you personal advice because that is always needing to be done on an individual, personalized, and customized basis. So if any of this resonates with you and you are interested in potentially looking to work with us, certainly reach out to the practice. You can find that at walserwealth.com, walserwealth.com. But this podcast is separate from that. It's just my fun analyzing data and giving you my analysis of that data. I enjoy it. It is something I do for fun, and I hope that it does help you in your life and planning your life. Like I said, it's not intended to be a commercial for the practice. If you're interested in getting personalized, customized advice, then certainly my practice of, we're a large team now of over 20 associates, will certainly be able to help you, and we're all trained according to my philosophies of what's happening. So with all that being said, let's get started, because this is probably one of the most important Crashes and Tax podcast episode that will ever be done. August 30th, 2023, that is when I'm recording this. And that is because of what has just recently happened. So let's go ahead and get to it on what has happened. So the first thing, before I want to give you a little bit of a backstory, this is a Zero Hedge article from February of this year, 2023, was talking to you about the U.S. has declared war on BRICS oil. So obviously, when Russia invaded Ukraine in March of 22, the West, and when I say the West, you need to understand that the West is not really a geographic designation. It's kind of the blocks that sort of aired out. So the West would be the United States at the top of the food chain, then Europe. So it's United States, Europe, Canada, Australia, New Zealand, and Japan. So Japan is a part of the West bloc, even though it's clearly in Asia and right next to China. It is considered part of the West. It aligned with the West. Really, most countries did post-World War II. And it has not rejoined, mostly because of their problems with China. It has not joined the BRICS bloc, which is Brazil, Russia, India, China, South Africa. It has not joined the BRICS bloc at all. And so that's why it's part of the West. So what this article is talking about is that as Russia got kicked out of the SWIFT system from the West after the economic retaliation, and many countries say that it was the United States weaponizing our currency as a foreign reserve currency, global foreign reserve currency. And so what has happened as a result of that is that world governments have made very slow but predictable reiterations after and doubled down, if you will. And what you now see is that the BRICS countries, Russia being really, if the United States was producing oil and crude and refining it to a level that we were when Trump was in his first term, you would see that we would be energy independent, and we were energy independent. Once Biden came back in, he clearly is much more on the green energy side and not wanting to promote or even leverage the fossil fuel capabilities that we have. So we've become a domestic importer again of crude. And Russia is one of the largest crude producers outside of the United States. Of course, that is represented by OPEC plus. OPEC is the block of 13 countries. Russia added is the plus part. So OPEC alone, excluding Russia, so just OPEC, not OPEC plus, would just be your Middle Eastern countries that are producing in a consolidated conglomerate type of fashion, and they produce in a block, meaning that OPEC sets the crude prices and the crude production and will change that according to what they want to do with global oil prices. And so what you can see is the United States has absolutely, in terms of green energy policy through the Inflation Reduction Act, which was really a green energy deal. As we all know, if you read the fine print, it is a green energy deal. And even Joe Manchin, who was really influential as the architect of that with the Biden administration, admits now that this was really not as what it was designed to be, and it's clearly a green energy deal. So between the Inflation Reduction Act and the complete disruption of production domestically, we have really set ourselves and aligned the United States against the 6 largest oil producers in the world. Now, that is very important for you to understand, although, of course, for our own autonomy, we could always go back to production again, although it doesn't come without a cost. But for right now, with the administration that's anti-production, we're basically in a dispute globally with the largest oil producers outside of the United States. This is also a Zero Hedge article. This is from June of this year. And this is gold is closer to centralized clearing and BRICS solution to SWIFT. Now, this is very concerning because we are in the middle of de-dollarization. It has begun. This podcast is a huge announcement towards that arena and that area. And you're going to see that in just a second. But I'm just giving you a backstory here that this was just in June of this year and this is what it says. This is huge. We will gleefully break it down best we can in our weekly Sunday post. This is a technical publication, but it lies directly on the path of things to do when building an alternative to SWIFT. So the BRICS doing this merely proves, in other words, tying their alternative currency to gold is doable. And it is incumbent that the West has purposely avoided it for at least a decade, in part repressing gold prices by dissuading ownership. Successful implementation will force the IMF and the BIS, which is the Bank of International Settlements. The Bank of International Settlements is the top central bank of the earth. That is the top central bank over the 82 other countrywide central banks of the world. So the implementation of BRICS to a gold-backed alternative to the SWIFT international payment processing system. This will force the West, lead the West to the negotiating table on international trade solutions to the US dollar hegemony. Gold must be a part of whatever fiat money is used in cross-border trades. Silver will not be far behind either. Further, in the East, it will back their domestic currencies, enabling them to unleash retail gold demand on a global basis. And then it talks about the new development bank, which is a consolidated conglomerate bank of these countries that would be a clearing center for a common BRICS currency. says a Russian foreign minister. Now, this was just announced in June. The announcement of this from a Russian foreign minister is what led India to sort of try to back themselves away while remaining in the BRICS bloc, and very clearly a part of the BRICS summit that just happened in the past 10 days in Johannesburg, South Africa. So what I'm trying to let you understand as a backstop before I go and give you this new information is that, number one, the United States has deliberately set itself up against the 6 largest oil producers outside of course, itself in the world. We are at war with the BRICS oil producing nations. And then geopolitically speaking, that's not a physical war. And then we have gold being a tether of a hard asset to a new alternative to SWIFT that the BRICS bloc is talking about. Now, all of that is extremely important and leads us to the real story of the week, which is just announced at the end of last week, not even a week ago today, that the first BRICS expansion in over a decade is happening as the Gulf oil powers join the bloc. Wow. This is what I have been talking about, dreading, and trying to prepare you for. BRICS basically being joined by Saudi Arabia and the United Arab Emirates. So the UAE and SA are officially joining the bloc, and they're making it official in January. Now, the reason to make it official in January is there's got to be a lot of groundwork laid for Saudi Arabia and the UAE to come in. What they just talked about in this South Africa Johannesburg conference, the 22nd through the 24th of August of 2023, when these massive earth-shattering decisions were made, was they were talking simply about bilateral trade, simply about trading between, domestic currencies. And so the Chinese yuan obviously has already, for the first time, bypassed the US dollar in its domestic transactions for the first time ever this year. So we know that China is massively bilaterally trading. We know that India has formal agreements with 18 countries and another 12 informal agreements, 30 countries trading with India in India's Indian rupee. We know that Russia is obviously selling oil outside of the US dollars and in rubles and gold. We know that liquefied natural gas has already been sold through the UAE in euros to basically France for the first time. That's already happening. So what is the reason for them delaying the actual official joining of the bloc until January is that they have to lay the foundational framework for these bilateral transactions to occur outside of the US dollar. Please hear what I'm saying. They are laying the groundwork in these next 4 months before January 2024 rather, for these transactions to occur outside of the US dollar. 6 countries were announced as being added. Argentina, Egypt, Ethiopia, Iran are the 4 additional outside of Saudi Arabia and the United Arab Emirates. Now, 23 countries officially applied to join the bloc. It's such a massive amount of countries that are coming to the BRICS bloc, the Eastern bloc of the world, that I can't even admit them all because it's too much work to be done too fast. They have to get SA and UAE as part of the bloc. And once that happens, well, it is the absolute official end of US dollar hegemony. It is the end of dollar hegemony. And I don't care who says it isn't. It is. Let's be real. Let's be honest. This is the end of complete dollar domination of global world reserves. This is the beginning of what we call multipolarity. We expect fully that the BRICS bloc, with their cyber platform crypto platform, if you guys will, a blockchain platform, mBridge. mBridge is the alternative they have come up with to the SWIFT payment system. And all that needs to be done now is two phases. Phase one is for them to trade bilaterally in domestic currency. So you've got China and India trading directly in Chinese yuan. You have India and Russia trading directly in Indian rupee. You have these massive populous countries trading directly, bypassing the US dollar. Okay. And that's phase one. That is massive. That's the end of dollar hegemony. That is the introduction of multipolarity. But phase two is the conclusion of multipolarity when the BRICS bloc will announce an alternative global reserve that will be backed by gold. And this is where you will finally see half of the world transacting outside of US dollars. And it's very close to that with just the 6 new countries they have just admitted. So let's get what type of size we're talking about. So here's the rise of the BRICS. You can see that, you can't see from this chart, but I will tell you that in 2020, the combined GDP of the G7 was surpassed by just the 5 BRICS nations, just the 5. The 5 original, Brazil, Russia, India, China, South Africa, passed the GDP of the G7 in 2020. Now with the addition of Saudi Arabia and the United Arab Emirates, we have a bloc that is about 46% of the world's population and about 37% of GDP. Now, the IMF puts it at about 32.1% of GDP inflation, buying power adjusted, which means a currency equivalent adjusted. But truly, that's what the IMF says, about 32%. You can see here, I have a CNBC article here. And right here, you can see that the Brazilian leader, go back, is stating that the BRICS is going to be 37% of world GDP in terms of its purchasing power. That is with the addition of Saudi Arabia and UAE. That's why it's going from 32 to 37. And it's about 46% of the world population. I mean, China and India are the 2 most populous countries in the world alone, 1.4 billion, 1.3 billion respective people in those countries. 2.7 billion people of the 8 billion people that live on planet Earth live in just those 2 countries. So obviously it's almost half of the world, and it's almost 40% of the world's GDP. And it's certainly all of the oil, for the most part, outside of the massive United States production that we have curtailed immensely because of political, decisions. So phase one has begun. Phase one is bilateral. Now, why is this such an issue? And for those of you that have been watching my podcast, you'll understand immediately that we're talking petrodollar here. For those of you that have not ever listened to my podcast and you don't even know what the petrodollar is or what dollar hegemony is, I'm going to give you 5 seconds of an explanation so that you'll be on the top of the speed with all of us. We started to come off the gold standard in World War II. We had debt in World War I, we had debt in World War II, but the Bretton Woods Agreement, which really happened in 1944 in New Hampshire, didn't occur until post-World War II. And that's where the world decided, okay, we don't want to be carrying gold across the oceans to transfer payments this way. We don't want that. It's a lot easier for us to carry paper. So we would like to carry paper. We like to have the same paper that we can use kind of everywhere that's got a set exchange rate to gold. If we decided, hey, we want to go to the United States and turn in all of our US dollars for gold, we can get gold. Gold and dollars were fungible. They were exchangeable in the United States. We started to have FDR recalled gold in 1933 with an executive order. People don't even know the history anymore. That did happen. But basically, we were fungible for gold until 1971. In 1971, August 15th, President Richard Nixon completely ended the gold exchange and the gold standard for the United States. He abruptly cut off and said, as of this date, you will no longer be able to turn in US dollars for gold. A lot of the gold was getting exchanged and taken out of US vaults, and Nixon had to stop that. So he did. And that took us off the gold standard completely in 1971. Well, obviously, not being tethered to any kind of hard asset started to make currency problems and currency manipulation and currency, inflation was coming. Inflation was happening because we were no longer tethered to a hard asset. So Richard Nixon tasked his Secretary of State at the time in 1974, Henry Kissinger, to go over and meet with the King of Saudi Arabia. And they worked out the petrodollar arrangement deal. And what that basically said was, Saudi Arabia, don't waste your money, don't waste the kingdom's money on building a military, funding a military, and having a military. What we will do in the United States is we will be your military. We will be your security. We will be your arm. We will come to defend you at any time you need. All we request is that you start and you control your OPEC block to only sell crude oil in the US dollar. And that is how we quasi became rebacked again by what we call black gold or crude. And the petrodollar arrangement was birthed. The US dollar had world stability because it was necessary to be bought from the United States so that you could go and buy your oil from any OPEC producing nation. And eventually that grew to OPEC plus, which is the OPEC nations plus Russia. That's the petrodollar. That is what was able to stabilize our currency. And certainly that was the true birth of what I would call absolute dollar hegemony, because now you have crude globally being backed, or backing rather, the US dollar. The US dollar has to be bought by the United States at the United States in order to go out and buy it from Saudi Arabia and all OPEC nations and even Russia. So that was the petrodollar. Phase one of the BRICS bloc agreement is to trade bilaterally. So what we are preparing for is for Saudi Arabia to formally announce that they will begin to sell crude outside of US oil. Now, we have two recent examples in history of two countries that tried or announced that they were going to sell crude outside of US dollars. And both of those announcements resulted in immediate war. So you had Saddam Hussein of Iraq announced that he would sell crude in euros, and we invaded Saddam Hussein in Iraq in short order. You had Gaddafi of Libya put together an African consortium of nations to begin to sell their crude outside of US dollar, and Gaddafi was subsequently removed by the United States militarily, and there was an Arab Spring. So we have examples of how serious that kind of announcement and pronouncement is, and how it's been dealt with in the last 25 years. Now we are seeing a global geopolitical shift in a block of nations. And so when Saudi Arabia announces that crude will be sold outside of US dollars, we are expecting a substantial and immediate dollar declination impact, without a doubt. And that is what we have been preparing our clients for, that we are in de-dollarization. It has begun. It has been happening super fast. And there is nobody on planet Earth who can tell us any differently, because the facts are on our side and the data is on our side. And let's look at the data. So this is a chart from just basically the last year. It only goes February to February. even though we asked for the June to May period, but the data is not always exactly very available granularly in a chart format. But what I want you to see is that this is in basically trillions. So you've got, 40 trillion of global reserves. These are the reserves of foreign exchange. So these are foreign countries that are holding US dollar as their foreign exchange. You can see just a year ago it was above 40. And by February of 2023, it's about 37.5. That's 2.5 loss, which as a percentage, you're talking about 5%, at least a 5% diminution in just the last year. If we look over the last 10 years, from basically the 2023 timeframe, you can see how much we almost have half of the reserves of what we used to have. We're here at 48, and we're coming down to here at 38. So we've lost 10 of 48, which is almost a 25%, or it's over 20% declination in the last 10 years. The world has been slowly de-dollarizing as it could, with dollar hegemony still being in existence and still having to buy still having to buy crude in US dollars, still having to go to the United States and buy US dollars in order to be able to go out and buy oil. So we have seen massive drops. And that is only since Russia has been kicked out of SWIFT, and they've had to bifurcate and denominate their transactions in outside currencies, in Russian ruble and gold and some euro. So we are seeing massive de-dollarization. And with this announcement, we have big structural problems dead ahead in the next 4 months. Dead ahead. Let's just go and look at a recap of the economy otherwise, because people keep talking about soft landing. And I obviously did the podcast, 2 weeks ago to give you all of the reasons that I think a soft landing is just impossible. Just to recap, we've got obviously economic data in Europe is going from bad to worse. This is the lowest point reading for European measurements, with the exception of the pandemic, since April of 2013, which is still part of the global financial crisis. The Eurozone of 20 nations that share the same currency has only grown by 0.3% in the second quarter and 0.1% in the first quarter. And analysts say that European Central Bank, which we know now they have raised. So let's read this. Eurozone business activity contracted at an accelerating pace in August as the region's downturn spread further from manufacturing to services. Europe is a leading indicator, kind of what will come to the United States. So I wanted to bring this in. And also, it's a global situation that's happening. We are going through a global depression. And that is before the capital is completely disrupted, as we hear from Saudi Arabia. So what we're seeing is that the economic downturn in Europe has spread from manufacturing to services. Both sectors reported falling output and new orders, albeit with the goods producing sector registering the far steeper rate decline. Hiring has come close to stalling as companies grew more reluctant to expand capacity in the face of deteriorating demand and gloomier prospects for the year ahead, the latter sliding to the lowest seen so far this year. Inflationary pressures continue to run far lower than seen over much of the past 2.5 years. Led by the falling manufacturing prices. August also saw headline rates for input costs and selling price inflation tick higher, due in part to previous upward price pressures. So I'm letting you know that Europe is about 6 weeks to 2 months ahead of us with data that's happening. So we like to look at them for a little bit of a leading indicator. That's what's happening in Europe. Let's see what's happening here in the United States. So we've got the S&P Global U.S. Purchasing Manufacturers PMI basically fell to 47 in August, down from 49 in July. We expected it to tick up to 49.3. Just so that everybody understands, 50 is neutral, above 50 is an expansionary manufacturing base, and below 50 is a contractionary manufacturing base. So we were expecting it to go from 49, which was contractionary, to 49.3, which would be less contractionary, getting closer to that 50 neutral. We actually contracted from 49 to 47. Let's continue reading. The latest reading signaled a solid deterioration in operating conditions midway through the third quarter. The decline was the second sharpest since January, primarily driven by renewed decrease in output and a more pronounced drop in new orders. The decrease in new sales led to manufacturers scaling back operations, resulted in faster reduction in input buying. The substantial decline in purchasing activity reflected a decreased need to store materials and finished goods, consequently leading to further reduction in manufacturing inventories. Despite the reduced demand, vendor performance improved, albeit to the smallest extent since February. Some companies know that a shortage of drivers at suppliers hindered efforts to shorten delivery times, which also contributed to this improvement. In other words, inventories were higher because the shippers, the actual final leg, which is the transportation truckers, couldn't actually get those supplies delivered. So what I'm trying to let you know is that manufacturing is in recessionary, contractionary space, which we are in, and that is now spilling over into services. And we're starting to see services in the United States also contract. So in general, we are looking at a recessionary, depressionary beginning time frame through the economic data that we're now seeing. This is the unemployment data I wanted to give to you. This was from August 21 from the Wall Street Journal. And this is just an article that is really analyzing how much pay has really been pushed because of inflationary, because of less workers. Those two are the two main reasons. Wage growth has been pushed these last 2.5, 3 years. But what we've just now seen is that that is ended, and that besides employers freezing job titles, they are reducing them by an average of $10,000 annually per person. That the era of you're going to leave and go get a better job for an extra 20,000, 10,000, that is ended, and that part is over. If we look at Powell and what notes he delivered at Jackson Hole this past Friday, August the 25th, he stated we still have a long way to go. And basically, if you had to summarize his speech here as Zero Hedge did, we aren't done yet. We ain't done yet is their thing. And why is that? What is it about Powell? And Powell has been able to leverage this super tight labor market that was created by the pandemic and all of the layoffs. And he's been able to really leverage that strength of the job market to be able to stem the rate hikes that we've had. However, that is changing. We are seeing massive softening in labor, with manufacturing PMI down, with services starting to now look like it's deteriorating. We're starting to see the very, very beginning of recessionary times. And so that is interesting that Powell would still continue to be hawkish. And that lets us believe and indicates to us that they are instituting and basically creating additional crises to help bring about currency transitions to the FedNow platform and eventually the digital dollar. There is a law that goes into effect this Friday, September 1st. And that is that Texas has created a gold-backed digital stablecoin. So they passed a law, and it has going into effect this Friday, September 1st, where they are buying Troy gold Troy ounces in order to back their Texas-created stable coin. And so when people say that de-dollarization is not going anywhere, the dollar's not going anywhere, that's true. The US dollar is not going to go anywhere. It will still be a part of the global world reserve system. However, it is no longer going to be the only player in that game. You're going to have the BRICS bloc. They are going to be backing an alternative global exchange currency to a hard asset, presumably gold, as announced. And that is going to force the fiat nations of the world, which include the United States, specifically the West, fiat currency being based on and tied to absolutely nothing of true value, just backed by the full faith and credit of the government institution that is creating those currency dollars or bills. And so it is going to force the fiat world to retether to hard assets again, which will make us take a hard look at the gold and silver that the world actually has. We'll probably finally get an audit of Fort Knox in Texas to see what is the U.S. gold situation really, what is the Chinese gold situation really, what is the Japanese gold situation. We really need to understand the precious metals of the world and where they're stored, because they are going to be the real currency again, and we will just have a tethering to digital coins that will be, the backing. But the world is going through a transition. And let me just take this off and just make sure I don't have anything else I really wanted to. Yeah, I do have one more slide to talk to you about. But let me just walk you through this as I end. The world is really going through a transition. We are going from total fiat, where the people have sort of lost their faith in that. And in this, if you understand that we recapitalized our investment banks by $11 trillion in the fourth quarter of 2019, and then we came around and printed another 10 plus trillion, 15 trillion in US dollars to get us through the pandemic. And that was just printed whole cloth out of thin air based on nothing. You can understand why inflation has come. If you just, break it down, economics, very basic, simple. It's just you and me, and we're the only two consumers in the world. And there's one loaf of bread, and I have $10 and you have $7, and the bread costs $5. Well, guess what's going to happen? If the $10 person really wants that bread and the $7 person really wants that bread, probably the price of bread is going to go higher than $5. It might go to $6.50. Now the $7 person can't afford to buy it because it can't only have 50 cents left over. And I, as $10, I'm pushing that price up. So what happens when you produce more money that is disseminated across the world? That money doesn't do anything other than make the prices of goods and services more expensive. That's all it does, because we're still chasing the same basket of finite goods and finite services. We're just chasing them with more total money. So what happens? Prices push up, demand increases. As if I was the $7 person before and I got priced out of the $5 bread, well, if the government gives me a $3 stimulus for coronavirus, now I have $10 and I'm equal to the $10 guy that he didn't get any stimulus because he was already rich. He didn't get the stimulus. Now we both have $10 and we're both chasing the same loaf of bread. That price is moving from $5 to higher until somebody gets priced out of buying it. That is how inflation comes, when you simply push money, fake money, to solve a problem. And what has happened through coronavirus is the world has seen that we can just print money willy-nilly and it doesn't matter. And that means prices are going up, and people are starting to realize that this currency manipulation is really fake. And certainly we have 46% of the world population, 37% of the world GDP that is saying, enough, America. We are not going to allow you to just basically devalue the dollar by printing it astronomically anytime in any way you want to. And good for them, because they're not wrong. I mean, economics 101, you can't cheat the system. You think you're just going to print money, everything's going to be solved? You are cheating yourself, and you're deluding yourself into thinking that that is a solution that is really going to last over the long term. So de-dollarization, my friends, is coming now like a freight train, dead ahead, right at us. And if you're not hearing it in the mainstream news, it's because they don't know what the result's going to be, or how to fix it, or how to still be on top and still control the world, as we have done really since the petrodollar was birthed in 1974. So watch out. And if your financial advisor that you have, or if you don't have one, isn't talking to you about these things, preparing you for what is coming and what is going to happen to the price of gold and silver, and whether or not that should be something that you leverage, if your advisor is not talking to you about any of these things, you guys, this is not status quo. This is the ending of what we established in World War II. It is happening now in 2023 and 2024. These are the years that it is happening. And if you're not taking that into account when you are looking at what you've done with your portfolio and your wealth, then I think you're going to miss the boat on this one. And it's not a boat that you want to miss. Absolutely not a boat you want to miss. So that's it for this week. It was a little bit longer than normal, but not quite so long. Have a great week, everybody. Until next week with Crashes and Taxes, I am your host, Rebecca Walser, and I hope you do well.